seniors in the profession, ladies and gentlemen. We have stalwarts. We have Mr. Yogesh over here. This paper on GAAR was, the presentation on GAAR was one of the finest papers that I have read so far on this subject. So let's try and get an overview. That's what I've been informed, that I need to provide an overview of the subject. Ketanbai said that I am a connected person, and thanks for the kind words. Ketanbai connected from the chamber is indeed a pleasure and a proud privilege. But let me tell you, all of us as chartered accountants, no doubt, no problem to be connected. But I think we all have to be now detached. In the sense that we need not get attached to the clients all the time and to their tax planning all the time. We need to detach ourselves from the client's anxiety of saving taxes and avoiding taxes. We have learned so far in the field of income tax that I, as a businessman, have a choice of doing my business the way I want, and so long as the transactions that I undertake are within the four corners of the law, then it is not for the tax department to have to impose these subjective standards on me and force upon me his thoughts of how I should be doing business, what sort of profits I should be earning, and things like that. That's what we have learned so far. GAAR brings about a little bit of change in this direction, and it now tells us that the officer, under certain circumstances, will have a right to ask you why you are doing what you are doing. So long as, so far, he didn't have much right to ask me why I am doing whatever I am doing so far. So long as it is within the four corners of the law, I was entitled to do it, irrespective of the effect thereof. And the effect would be mitigation of my tax liability. But now, I am answerable, and the officer has the authority to ask me why you are doing what you are doing. Now, this is the underlying sort of principle that we need to keep in mind throughout the course of the day when we are dealing with the subject of law. If we go to the Finance Minister's speech of 2012, he said that I propose to introduce GAAR in order to counter aggressive tax avoidance schemes, while ensuring that it is used only in appropriate cases by enabling a review of GAAR plan. So, counter aggressive tax avoidance schemes is one of the underlying aspects which points out the need for having provisions of GAAR in this country. So, just try to summarize what the need, why do we need the provisions of GAAR in our tax law, counteract and negate abusive tax avoidance. It's basically, if one looks at the explanatory statement of the Finance Bill of 2012, these are the points which were mentioned by and large over there. And the underlying theme is to incorporate the concept of substance over form in our own tax law by way of separate provisions of the Act. The explanatory memorandum said that where real intention of the parties and the purpose of an arrangement is taken into account, irrespective of the legal structure. Despite the fact that India today has a moderate tax rate, moderate rate of tax, we find that there are aggressive tax planning, tax avoidance schemes, and therefore, in order to combat that, these provisions are being brought into the state. We find references to things like treaty shopping in the context of international taxation. And once again, the finance minister in his speech went on to say that sometimes we see investments coming from no tax or a low tax jurisdictions. He said, I don't mind investments being made in this country by people who are running businesses. However, he said that when I find that there is no establishment, there is no office, the address of the office is that of a chartered accountant or tax consultant in that country, he asked us a question and said, in such cases, should I not prevent it? Because this is where the concept of treaty shopping comes in, that a resident of country A, okay, goes and opens a shop in country B and does business with country C. Why? Because between B and C there is a favorable tax treaty, and therefore he opens a shop there. He doesn't open a shop of substance, but he puts a name tag over there where he says that, okay, this is my office, this is my place of business, and therefore this is my address over there. And that is how he does business over there, do business through that country, using that third country as a conduit, and thereby taking advantage of the favorable tax treaty with the jurisdiction with which he is doing business. So this was another aspect which was highlighted in the finance minister's speech, and all these thoughts have ultimately boiled down to codifying these provisions of anti-avoidance by way of a separate chapter under the Income Tax Act. Now, that takes us to the background, namely as to what is that which is supposed to be attacked by GAAR. Because when I say that I would like to reduce my tax liability, there are three concepts. First concept, tax evasion. I evade taxes. That's a black area. Why black area? Because it is illegal, it is unlawful. And it is the result of illegality or suppression or misrepresentation of fact, it's a fraud. And if that be so, tax evasion is actually tackled by the provisions of the Act itself, or they are tackled by the provision, by the judge-made law. And therefore, irrespective of whether you have GAAR or you don't have GAAR, these are the provisions which are, this is an action, rather, this is an action, tax evasion is an action which has never been considered to be lawful, it has never been considered to be an acceptable position, and therefore I would put it as black area. You don't really need GAAR for tax evasion because you have provisions in the Act itself to take care of that. So say for example, penny stocks. Say for example, unexplained cash credits. Say for example, on-money transactions. These are all cases of tax evasion. And in cases of tax evasion, the statute or the courts have taken care of this, and you don't really need GAAR in order to rope these transactions within the end of tax. That is the first category, the one extreme. The other extreme at the bottom is tax mitigation. Tax mitigation is where the taxpayer uses a financial incentive provided under the tax legislation, fulfilling all the conditions and the economic consequences there. So, I am entitled to certain deductions, certain exemptions, and I claim those deductions and exemptions which are provided in law. And that is how I mitigate my tax liability. And if I do that, then that is something which the tax law statute allows me to do. And if it is allowing me to do, it may be my sole intention to take benefit of that. I invest in a particular bond, although it does not make any commercial sense to invest in, say for example, a capital gain bond which gives you only 4% or 4.5%. That does not make commercial sense. It definitely lacks commercial substance. Yet, I make investment there. Why? Because there is an exemption or deduction which is specifically provided under the statute which says that if you invest here, then I will be giving you this exemption, and therefore I do. The sole purpose is to mitigate the tax liability. But because this is the sole purpose, it does not become a tax avoidance or a tax evasion. Why? Because the law itself provides a deduction to me so as to grant me this deduction. So this is a case of tax mitigation, and ideally, therefore, in cases of tax mitigation, there is no question of applying GAAR, because GAAR does not want to attack cases where the law itself provides for a deduction, where there may be an economic purpose. The economic purpose may be to give boost to that industry where those bonds will be ultimately invested, or there may be an economic reason, give a boost to you to transfer your industries from a backward area to urban area to a backward area and things like that. So therefore, these are all aspects of tax mitigation, and tax mitigation is something which is permitted in law, and therefore there is no question of applying. So these are the two extremes, evasion and mitigation. One is illegal, one is completely legal. In between lies a grey area, and that grey area is that of tax avoidance. And therefore, this is an area which GAAR really intends to attack and identify which sort of tax avoidance is acceptable and which tax avoidance is not acceptable. So that is why in law we have permissible and impermissible avoidance agreements. Okay, so avoidance, there is an avoidance, but avoidance may be permissible, avoidance may be impermissible. So if an avoidance is permissible, there is no question of applying GAAR and recharacterizing or doing anything of that sort. But if it is impermissible, then the consequences may follow. So that is the overall position where we are. GAAR intends to tackle that grey area, the in-between area of tax avoidance. The framework of GAAR under the statute is sections 95 to 102, where applicability and definitions, what is impermissible avoidance agreement, what is a range of it, what are the consequences, etc. We have these specific provisions. Then we have a full-fledged provision in 144 VA about administration of GAAR. And then we have certain rules as to whereby under rules there are certain entities who are exempted. Then there are the procedures which are laid down in the rules as to how should the effect of these provisions be actually implemented. And we have a circular number 7 today, which by way of certain FAQs seeks to clarify the position taken by the CBDT on the aspect of GAAR, on certain aspects. So today this is the framework of the provisions of GAAR as appearing in our Act and rules and by way of circular. Now, a snapshot of how this whole chapter works. The first question that one asks is there an arrangement? Now, what is arrangement, etc. we are going to see in the next session when Geeta will be enlightening us on the nitty-gritties of all these terminologies and what is permissible, what is impermissible, what are the tests should take us through that. But just a snapshot to set the stage, ball rolling. Is there an arrangement is the first question you ask? And if the answer is no, then the question of GAAR applicability does not, right? You just say that GAAR is not applicable if there is no arrangement. But then, if the answer is yes, okay, there is some arrangement, there is some transaction which is happening. Then, ask the next question, what is the main purpose of this arrangement? Main purpose of the whole of the arrangement, a step in the arrangement or a part of the arrangement, is that main purpose obtaining a tax benefit? And if one comes to a reasonable conclusion that no, the main purpose is not that of obtaining tax benefit, then once again that arrangement is not an IAA, that is not an impermissible avoidance agreement. And if it is not an impermissible avoidance agreement, then obviously GAAR is not applicable. But if the answer is yes, the main object of this transaction is to really get a tax benefit. Then you ask other questions, set of questions, that okay, if the main purpose is of getting tax benefit, then does the arrangement contain any of the following tainted elements? What are these tainted elements? That it's something which is not an arm's length. That means the transaction is such that it would not have happened between two parties working on an arm's length basis. It's some sort of an artificially arranged transaction. Or is this misuse or abuse of the tax provisions? Does it lack commercial substance? And is it for a bona fide purpose or not for a bona fide purpose? Now these are what are known as the tainted elements. Geeta will take us through in the next session whether these are all cumulative, whether they are all non-cumulative. Is it that if any one of these is satisfied, you still fall within the ambit of GAAR? Or is it that all the four should be satisfied? Then and only then you will get into GAAR, otherwise it is not an impermissible arrangement. There are lots and lots of views on this, and I would not like to color that at the moment on this subject. The controversy is because there is a word or which is used after clause C, and there is no word or used after A or B, and therefore the question arises, is the choice only between C and D, or is it all four are, you have to read it as or? I mean, that's a question of interpretation. These are questions which have been bothering us, and there can be one view or the other on this one. So, but then the question is that if the answer to this question is yes, that yes, there is a tainted element involved, then the arrangement would probably be an impermissible avoidance agreement. And if it is no, then there is no question of GAAR being application. So now, if you come to a conclusion that yes, this is an impermissible arrangement, then what are the consequences? Then you go to the consequences. These are the consequences which are listed in the statute, and here again we'll be getting into it in greater detail, but I've just listed them over here for the sake of our overall understanding of the subject. Consequences could be anything. It's absolutely wide. Disregard a transaction, combine two or more transactions, recharacterize a transaction, recharacterize one of the steps in the transaction, treating the impermissible arrangement as if it had not been entered into or carried out, just ignore it, disregarding any accommodating party, so there will be several parties involved in the transaction, so disregard one of the accommodating parties, deem the connected persons to be one, so they are not two separate entities, you create an artificial entity, and therefore it's impermissible avoidance, and therefore you combine two or more connected persons. Reallocate income, reallocate expense, assigning the place of residence, so you created an artificial place of residence in some country, and you say that okay, I am a company incorporated in that country, and therefore I should get that treaty benefit. Answer. And if it is an impermissible arrangement, if it's treaty shopping, you say no. You are not a resident of that country, so you redefine or reassign the place of residence. Disregarding a corporate structure, so piercing of the corporate veil, and so on and so forth. So these are the consequences which have been listed in the Act, that once a decision is arrived at, that yes, it is the arrangement that you entered into is an impermissible arrangement, then what happens is that these are the consequences, and they are so wide that it may have far-reaching implications on the tax liability of not only the person concerned, but the entire group of persons who are engaged in this entire exercise of tax avoidance, tax planning. Having seen this, let's get into the topic of judicial anti-avoidance rules, where we are all aware that there has been a flip-flop journey so far as India is concerned, and therefore one of the things that Finance Minister said in 2012 is that, or it is there in the explanatory memorandum, that courts have been taking different views on the concept of applicability of anti-avoidance or anti-abuse rules in this country, and courts have at times taken a view that so long as the transaction is within four corners of the law, you don't have to get into the motive for which the transaction was undertaken. And therefore that transaction is legal and the tax effect may be anything, you don't have to go by what is the tax effect. Whereas in cases like McDowell, etc., we have seen that the motive of the transaction was considered as to be of prime importance. So this is where the concept of GAAR, that is the judge-made anti-avoidance rules, come in, and we'll briefly deal with some of the landmark decisions on this subject. It all started really in the UK with this decision of the Dukes of Westminster, where this was discussed at length, probably for the first time in the UK by the House of Lords, that the difference between tax avoidance and tax evasion. And the view which was taken was that avoidance of tax is not tax evasion, and it carries no economic weight. For it is sound law and certainly not bad morality for anybody to so arrange his affairs as to reduce the brunt of taxation. So here was the first distinction made between avoidance and evasion. And we were told that evasion may be bad, but avoidance is not bad. And therefore, that started the journey of giving a green tick to tax avoidance, although tax avoidance is considered to be not legal, not moral. Now this concept has been followed in India in several cases. The landmark decisions I've just listed down over there. One of the early decisions was that of 55 IPR, where an individual had put his property, thrown his individual property into the hotspot of his joint family. And in those days we didn't have 64(2) where the clubbing provisions were applicable. So that, having done that, it became the property of the family, and thereafter he partitioned the family. And having partitioned the family, his wife and minor children got certain amount of the property over there. So had he directly gifted that property to wife and minor children, the tax consequences would have been different. But he chose this route of first throwing it into the family and then partitioning the family and giving the properties to the ladies and the minor children. And the question arose as to whether this is something which is permissible, which is not permissible. And here in this particular decision, the Supreme Court said that look, what the SSE has done is well within the four corners of the law. And therefore one need not go by his intended motive. You cannot extrapose any motive, as to why he has done it and thereby disregard the transaction. So uphold this theory that it may be an avoidance by way of complying with or remaining within the four corners of the law, and this cannot be characterized as evasion, and therefore it is permissible. Then we had these two landmark decisions of A. Raman and B. M. Kharwa, and in A. Raman it was a case where there was an income which was diverted by overriding title, and the court said that whatever arrangement you make, if the income has accrued to you and the income has then passed on, then it will be treated as your income. But you have right to arrange your affairs in such a manner that the income does not accrue to you, but are diverted by overriding title. And by doing that, there is nothing wrong that you are doing. If you are entitled to arrange your affairs in such a manner that income does not accrue to you at all, and therefore there is nothing wrong in that. The law does not expect a person to earn maximum income. So once again, although it resulted in reduction of tax liability, this arrangement, the court upheld that, and of course by applying these principles of Dukes of Westminster, etc. And again we have this decision of Supreme Court in B. M. Kharwa, where it was categorically held that taxing authorities are not entitled to ignore the legal character of the transaction and to proceed on what they regard as a substance of the law. The court did say that if the legal relationship is concealed by a device, then court can unravel that device. But if as a result of certain transaction there is a legal effect which is being created, I have transferred a property and therefore you become the owner of the property, and therefore that's a legal consequence or legal effect. And if that legal effect is so, then you cannot say that this transaction was done for the purpose of tax mitigation and therefore this is a tax evasion transaction. So you cannot ignore the legal effect of the transaction the legal form has to be therefore given effect. So again, legal form versus substance. Here the legal form survived as compared to the substance of that of tax avoidance. However, this was the position in the UK. However, in the US, way back in 1935, we have this decision of the US Supreme Court, which has frowned upon the tax avoidance right from 1935. What are the facts over here? There is individual which owns company A, and that company A owns company B. Company A, apart from owning the shares of B, had various other things in it, various other businesses. Now this individual wanted to sell the shares of this company B and get money in his own hands. So ideally, if the shares would have been sold, company A would have paid tax on it, and then that money would have been declared by way of dividend, and then on that dividend, that individual would have paid tax on dividend. So instead of doing that, they worked out a scheme. That scheme was characterized as corporate reorganization. And in the course of corporate reorganization, what they did was, that individual floated another company C, and then A had transferred the shares to C. In the course of corporate reorganization, owners being the same, there is no substantial change in the ownership, and therefore it was labeled as corporate reorganization. So transferring from A to C, corporate reorganization, no tax as per the provisions of the law at that point of time. Thereafter, soon thereafter, that C was dissolved. C, which was created for the purpose, it got the shares transferred to itself in the label of corporate reorganization. Then that C got liquidated. As a result of liquidation of C, the shares came directly into the hands of that individual. Thereafter, that individual sold the shares, paid whatever tax was there on the sale of shares, and thereby avoided 2 levels of taxation. Now, this came up before the Supreme Court as to of the US as to whether this is permissible, this is not permissible. And this, in the US, marks the origin of the anti-avoidance doctrines. At the first stage, at the Court of Appeal stage, this was negated by the Court of Appeal as an impermissible transaction. And what the Court of Appeal looked at was the purpose of the legislation. And they said that you may call something corporate reorganization, but was that the purpose of the legislation when they gave you exemption for corporate reorganization? Said reorganization anticipated readjustment to be undertaken for the reasons that are germane for the conduct of the venture. To dodge the shareholders' taxes is not one of the transactions contemplated under corporate reorganization. So they said that this is not corporate reorganization as is intended by the legislation. So they went into the purpose of legislation and said that this is something which is outside the purpose of legislation, and therefore you don't get this exemption, or whatever the tax benefit you got was considered as not those. The matter went into further appeal because Supreme Court, and Supreme Court added one more aspect to it. While the Court of Appeals looked at the purpose of the legislation, the Supreme Court looked at also the intention of the taxpayer. And it labeled this transaction as simply an operation having no business or corporate purpose. It went into the purpose for which the transaction was undertaken. There was no commercial purpose, no business purpose. It was regarded as a mere device which put on the form of corporate reorganization as a disguise for concealing the real capital. And having gone into this intention of the taxpayer, also approved the observations of the Court of Appeals that this was not even the purpose of the legislation. So now, why I am laboring on this is this, that these are the two concepts that you look at, these are the two aspects that you look at. The intention of the legislator in having certain exemptions, deductions, number one. And number two, the intention of the taxpayer in undertaking a particular transaction. These are the two aspects that one looks into while deciding whether a particular transaction is permissible or not permissible. This forms the basis, as we will go along and see later on, forms the basis, or this is also the approach that we find in the VAT section plan 6, where they talk about principal purpose test. So these are the two aspects that one looks at: the purpose of the legislation and the intention of the taxpayer. So this was a negative decision at that point in time of the US court. And then we have all these well-known celebrated decisions of the House of Lords in Ramsey, where it took a U-turn as compared to the Dukes of Westminster, and it dealt with sham cases, cases of ready-made schemes, cases of transactions which are self-cancelling. I manufacture a law scheme to set off some profits. Transactions which they say which are commercially inert, only fiscally active. A commercially inert transaction, only fiscally active. So there is no commercial purpose. A prudent businessman would not have done it. I have done it only because there is some tax benefit of doing that. So therefore, the House of Lords cautioned against the preordained, prearranged scheme having no commercial substance from tax avoidance, apart from tax avoidance. So this was really the emerging decision which gave emergence of the fiscal nullity doctrine. Fiscal nullity doctrine in the sense that there is no commercial motive. The transaction is commercially inert. It's only fiscally active, and therefore this is to be considered as something which is a sham transaction and not a permissible transaction from purpose of tax. Now this was later on followed in other decisions of the House of Lords, and this is regarded in the tax literature as a befitting burial of the Duke of Westminster's doctrine, and this follows what is known as the Buzzard approach. Thereafter, as we all know, we have McDowell's decision and the main decision by Justice Raghunath Mishra, supplementing decision by Justice Chinnappa Reddy, and Justice Chinnappa Reddy went on to decide and write his own judgment, where the distinction between tax avoidance and tax evasion was sort of blurred. Dismissed the observations of A. Raman and Company, which we just saw. In A. Raman and Company, Supreme Court upheld that so long as something which is within the four corners of the law, you can do it. Those observations were sought to be dismissed by him. And therefore, once again, we opened the debate of Ramsey on one hand and Dukes of Westminster on the other. After that, so this was one wave which remained for quite some time. And then we had this decision in Azadi Bachao Andolan, which was in respect of the India-Mauritius Treaty, and then would say that an act which is otherwise valid in law cannot be treated as non-est, merely on the basis of some underlying motive, supposedly resulting in some economic detriment. It went into the purpose of treaties, why treaties have been formed, and said that the purpose of the treaties is merely for the purpose of, for economic reasons of both the countries, and so long as that is achieved, then you can't get into a underlying motive supposedly resulting in some economic detriment. So who decides whether this is to the economic detriment of the country? Is it the revenue officer, or is it the government which has signed the treaty? And that is how they took a decision that that this is something which is permissible, and therefore it is it cannot be regarded as a sham transaction or impermissible transaction. So once again, that Duke of Westminster principle and Raman's decision was resurrected, so to say, and the observations of Justice Chinnappa Reddy were brushed aside, saying that those observations were only his observations and not those of the majority of the judges in that particular case. And thereafter we had, in the context of dividend stripping, Walford decision, which once again upheld that a mere tax planning without any motive to evade tax through colorable device is not frowned upon. And finally, the Vodafone decision, where once again the concept of avoidance versus evasion and it upheld, if you see the last bullet point, the revenue can invoke substance over form principle or piercing of corporate meaning test only after it is able to establish on the basis of facts and circumstances surrounding the transaction, the illegal transaction, a sham or tax avoidance. So otherwise, something which is within the four corners of the law, you cannot be really getting disregarding that transaction. Now, this being the position, this being the ups and downs of the judge-made anti-avoidance rules or applicability of anti-avoidance doctrines, the essential aspect is that of substance over form, and characteristics of a scheme of GAAR reflects the principle laid down in McDowell. So that's where the necessity of GAAR came in. That as mentioned in the explanatory memorandum, as I mentioned earlier, that GAAR is because you have court decisions which have been taking different views. This is a wave that you see all over the world. You see the BEPS Action Plan 6, where treaty shopping, etc., has been considered to be now impermissible. And this is a wave which is now there in the entire world. It's not just India is getting into GAAR. It's the whole world where the tax authorities of all the countries in the world is now looking at anti-avoidance as the and codifying the provisions of anti-avoidance in the legislature or in the treaties, and we are right now going through that phase where you will find a change between what has happened, what we have lived with so far, what we have learned in our tax laws so far, and what is going to come in the years to come. So therefore, GAAR codifies and gives a legal recognition of JAR wherever those anti-avoidance rules of McDowell, etc. are there. It is an extended and a modified version. I would not say it is exactly the same version of McDowell which is there. It is probably something more than that. It's an extended version of judge-made anti-avoidance rules. Question whether JAR can be invoked to the extent of exclusions provided in the GAAR. Answer is yes. So there are some small transactions less than 3 crores which are excluded. There are transactions prior to 1st April 17 which are excluded, but then the judge-made anti-avoidance regulations can always be applied to those transactions. So we have seen JAR. Now let's see SAR. What are SARs? Specific anti-avoidance provisions in the Act. I just listed down some of the anti-avoidance provisions in the Act. 222 deemed dividend. Then we have 9 explanation 5 indirect transfers. 14A, 40A2 and 92, there is transfer pricing, domestic and international. We have 50C, CA 50D, when property transactions are undertaken at less than the fair value. 56(2). We have section 60, 61, 62, 64. Section 79, you transact or you sell, buy or sell companies only for the purpose of buying and selling of the losses of the companies. Then in tax deduction provisions like ATI, AIB, you have those provisions, specific provisions which say that if there are intra-company transfers or inter-company transfers, inter-unit transfers, then they should be on an arm's length basis so that you do not overstate your profits on the eligible undertaking. So these are inbuilt SARs, inbuilt anti-avoidance provisions in the Act itself. Chapter 10, entire chapter 10, transfer pricing, 93, which talks of avoidance of income tax by transfer of income to non-residents, to transfer of assets, etc. Then you have dividend stripping, bonus stripping in 94, in capitalization, secondary adjustments, etc. etc. There are several such specific anti-avoidance provisions. The question that may arise is that where there are specific anti-avoidance provisions in the Act, would the general anti-avoidance provisions be applicable? That's a question that bothers us time and again. And let's see few examples in this chart. Say section 222. We have 222E, which talks of a loan or a deposit to a shareholder is to be considered as deemed dividend. Now, we have decisions to say that a deposit is not loan or an advance. There is a legal distinction between what is deposit and what is a loan. And you have classic decisions of the Bombay High Court in the context of section 370-372 of the Companies Act, which had made this distinction. And following that principle, you have decisions of various tribunals, benches, saying that a deposit is not a loan or an advance, and therefore, if there is a deposit, section 222E is not applicable. Now, in the scenario of GAAR, will you get those sort of decisions if the assessing officer applies GAAR? Assessing officer may accept that this is a deposit. Then what happens? Will you look at the arrangement? What is the arrangement? The arrangement is that, first arrangement is that there is a transfer of money, which is a debt. And then that money which has been transferred in the form of a debt has been structured as a deposit rather than as a loan. So if it is structured as a deposit, it has there is a legal distinction between a deposit and a loan. So the aspects of deposits are there in your deposit agreement. So if they are there, then a court would say that okay, there is a deposit and therefore it's not loan or an advance. In the context of GAAR, is the assessing officer entitled to ask you a few more questions on this, or he is not entitled to ask you questions? If he sees that this is structured as a deposit only for the purpose of tax avoidance, that is what he will presume, and he will start his inquiry from that basis. And then he will say, okay, is this a transaction which is normally done? Is that company normally accepting deposits? Or this is only one-off type of transaction? And you find this is only one-off type of a transaction. There are no deposits from anybody except for this shareholder, except from this company that this company, shareholder has taken a deposit. So, it's not something which is in the ordinary course of business. Does it amount to misuse or abuse of the provision of the law? You may say yes, you are misusing the concept of deposit versus loan. You are using this as you are running this as a current account, giving and taking of money at any time at will, and you call it a deposit. How can that be? So, is it a misuse or an abuse of the law? Is there any commercial substance in the deposit? So, these are the questions which the assessing officer might ask. So, therefore, let's not get into details of this. But the point I am making is that if there is an anti-avoidance provision in the Act itself, there is a specific anti-avoidance provision, you have an answer to this, a legal answer to this, that okay, this is not a loan and therefore it's a deposit and therefore 222 does not apply. In the era of GAAR, will that argument be available to you or will it not be available to you is something which needs to be considered. The arrangement of structuring a transaction as a deposit, if it is an unnatural transaction of a deposit, then it might get caught within the ambit of GAAR, and you might not get the decisions that you have got in the past. You might not get such decisions in the years to come if GAAR were to be applied. Take another example of 48.2. I make a payment of royalty. 48 and 92. 92, say for example, I make a payment of royalty to a company in the tax haven. And that royalty payment is arm's length price. No dispute on that. There is also no dispute that I actually utilized that IPR and therefore I am entitled to make the payment of that royalty. Now, the fact is that that company, the owner of the IPR is sitting in a tax haven. In making his assessment, can the assessing officer ask the question, why have you come to the tax haven? Why have you set up your IPR in the tax haven? Is there a commercial substance in it or is there not a commercial substance? Are you doing a treaty shopping or are you genuinely stationed over there in that tax haven? Is the tax officer entitled to ask that question or not? Despite the fact that you are satisfying the specific provisions of transfer pricing, there is no dispute that this is an arm's length royalty. There cannot be anything further taxed in the hands of that non-resident, or nothing can be disallowed in the hands of the resident who makes the payment. Yet, can the tax officer ask him the question, why you have come to the tax haven? Is this treaty shopping? Is this not treaty shopping? Okay, so probably in cases like this, he can ask that question. And if he comes to the conclusion that this is indeed a treaty shopping, then the consequences would follow. And therefore, independent of whether I am paying an arm's length royalty or not, these questions must arise. As against it, take example of 50C cases. I have sold a property at a stamp duty value, and that stamp duty value is far lower than actual market price which is there prevailing, because my next door flat has been sold at a much higher price and I am selling it at a lower price which is within the stamp duty valuation. Something which is not unknown to all of us. It happens in the city of Mumbai every now and then. In case like this, can the tax department invoke GAAR? In a case like this, to my mind, tax department cannot invoke GAAR because there is a specific anti-avoidance provision which has a specific measure. It has measured that this is the amount of tax which has been avoided and I will tax you. Having provided for that, we cannot go to a general anti-avoidance provision and increase my tax over there. If you do that, you are rendering the specific provision redundant. So in cases like that, there is no question of invoking GAAR. You have to stick to that specific anti-avoidance provision, or you delete that provision from the statute and you do whatever you want to do within GAAR, and that will create a havoc. So therefore, in such cases of specific anti-avoidance provisions, there is no question of invoking GAAR. But take another example. That I have sold this, when I purchased this flat, I have purchased this flat at a much higher price. At that time also it was higher than the stamp duty valuation. Today I am selling it to one of my sister concerns at a stamp duty valuation and therefore creating a loss. Having created a loss, I have set off some profits. In such a situation, can the tax department invoke GAAR? Is this an abuse of the provisions which are contained in section 50C? Very, very difficult to answer, because I would say that when there is a specific anti-avoidance provision, such a thing cannot happen. But however, the approach of the department, and as you will see from the question and answers, that the approach of the department is that if these specific provisions, despite the fact that specific provisions are there, but there is an abuse of the provisions of the law, then GAAR can be invoked. And therefore, there could be a hanging sword in such type of instances. Then once again, say for example, 94, dividend stripping, bonus stripping. I undertake a transaction of dividend stripping which strictly complies with my 94/7 time limits, 3 months, 9 months, whatever. Strictly complies with it. Your decision of Walford prior to those days. Now today I am complying with the provisions of 94/7 and saying that I am within this provision and therefore this loss cannot be discovered. But the fact remains that I have undertaken this transaction with a view to generate a loss. There is no commercial purpose at all. The only purpose is creating a loss, getting a tax saving. If I look at my arithmetics, my commercial reality, then the loss in the transaction would be offset by the tax savings and therefore my real gain is that of a tax saving. So main purpose is that of tax avoidance. In such cases, can GAAR be invoked? To my mind, no, because this is a specific provision which once again measures, provides conditions that under this situation the loss will be disallowed, and beyond this there is no question of disallowance. So a specific anti-avoidance provision providing for the measure, providing for the conditions, I satisfy those conditions, I am within that measure of the quantum, etc. Then there is no room for applicability of law. That's what my view is. However, as I said, one will have to wait and see as to how does the tax department deal with these issues. Similarly, thin capitalization. Thin capitalization today is based on EBITDA 30%, interest being less than 30% of EBITDA, more than 30% of EBITDA. But if I look at balance sheet, I may have a situation where it is indeed thinly capitalized, a very small capital and a very large interest. But it satisfies my EBITDA criteria. If it satisfies my EBITDA criteria, then these provisions cannot apply. Still, whether the in general principle thin capitalization can be applied. To my mind, answer is no, you cannot apply because you have a specific provision over there. You can't go to the general provisions. So, these are the type of controversies which will come in the years to come. If you look at the literature on this, if you look at the draft guidelines for the GAAR implementation of the direct tax code bill, at that time it was introduced for the first time. It said that while SARs are promulgated to counter a specific abusive behavior, GAARs are used to support SARs and to cover transactions that are not covered by SARs. Under normal circumstances, where specific SAR is applicable, GAAR will not be invoked. However, in an exceptional case of abusive behavior on the part of the taxpayer that might defeat a SAR, GAAR could be invoked. Then, if you look at the Shore Committee's report, there they said the committee recommends that where SAR is applicable to a particular aspect or element, then GAAR shall not be invoked to look into that aspect or that element. That was the recommendation of the, I just read the last paragraph of that. It is a settled principle that where a specific rule is available, general rule will not apply. SAR normally covers a specific aspect or situation of tax avoidance and provides a specific rule to deal with the specific tax avoidance. So they have taken a view that where a specific provision is there, then GAAR shall not be invoked to look into that particular aspect. The examples that I gave of 9470, 50C, etc. However, when one looks at circular number 7 of 2017, in that question, will GAAR be invoked if SAR applies? Look at what CBDT says. It says it is internationally accepted that specific anti-avoidance provisions may not address all situations of abuse, and there is need for general anti-abuse provisions in domestic legislation. The provisions of GAAR and SAR can coexist and are applicable as may be necessary in the facts and circumstances of the case keeps its avenues open. There is no answer to the question which has been raised. So therefore that gives the mind of the CBDT that you expect a lot of litigation on this aspect in the years to come. Let's take a couple of illustrations on this. You have this holding company and a subsidiary company. The subsidiary company has substantial carry forward losses, whereas the holding company is a profit making company. And you go in for a merger of the subsidiary into the holding company. That merger scheme is a qualifying merger scheme under 2(1)(b) of the Act. That transaction of this merger is exempt under section 47. The losses are to be allowed to be carried forward and set off by the holding company under section 72 capital A. The predominant purpose, say for example, the predominant intention behind this arrangement is of setting off losses. This is just theoretical proposition to understand a particular aspect. that it is an admitted position, or it is established that this is the main purpose of doing this particular transaction. Now, in such a situation, can GAAR be invoked? Here, if you look at the provisions of section 72, it has specific provisions of dealing with non-genuine mergers. It lays down conditions that you continue the same business for 5 years, you achieve a certain 50% capacity utilization for a period of time, that a certain quantity of 75% of the assets should be transferred, so on and so forth. So there are inbuilt conditions in the section itself in order to take care of avoidance aspects. And therefore, those conditions are in the nature of SAR specific anti-avoidance provisions. So long as I comply with those conditions, this reverse merger of a loss-making company to a profit-making company, should it be permissible or should it not be permissible? To my mind, the question of GAAR being applicable over here does not arise. Because so long as you are remaining within the specific conditions, avoidance conditions mentioned in section 72A, you cannot invoke GAAR to say that, look, we have done this only for the purpose of setting off the losses in the holding. I don't think that will be open to the tax department. As against this, you take another example. Instead of a merger, I do a demerger. Now here, we change the fact that the subsidiary company is not an industrial undertaking. It is a trading company. Now we all know that if we merge and if we want losses, then there should be an industrial undertaking, otherwise 72A losses will not be applicable. Now that condition is applicable only if it's a merger. It's not applicable in demergers. Now take for example, the subsidiary is a trading company. That trading company has got substantial carry forward losses. And this subsidiary company wants those losses to be set off in the holding company ultimately. If it merges, those losses will not travel because it's not an industrial entity. So what does it do? It starts some small consultancy company, consultancy business. So therefore it has two businesses, consultancy and trading. Then removes the trading division and demerges it into the holding company. So subsidiary remains, continues that small consultancy business. But the major chunk has gone up, the trading business has gone up. 72A4 says what? That the losses will travel in proportion of the assets getting transferred. Or the losses, if they are identifiable to that loss-making unit, will get transferred. Now unlike merger, you don't have a condition of there being an industrial entity. So you are completely within the four corners of the law. You have done a demerger which qualifies all the conditions of demerger. And therefore the question will arise that will GAAR apply in such situation? Now if we go to the answer provided by the CBDT, is it an abusive application from the provision of the Act? And what are those abusive steps that the CBDT may allege? So you started a small consultancy, never in your lifetime you have done consultancy. You started that small little business, a tiny business. Soon thereafter, you demerged this division upwards, got the advantage of set off of losses, and thereafter, I don't know what sort of consultancy continues in that company. So practically, it was a merger, but you structured it as a demerger, and therefore, it's a misuse or abuse of the provisions of the law, and therefore will apply GAAR and whatever consequences may follow. Possible. Can't rule out this possibility in the area of GAAR. Prior to GAAR, we could have done this without much thinking. But today, it seems difficult to get into such sort of gross, use or misuse of the provisions of the law. That takes us to some of the aspects of the tax treaties, and two aspects will be dealing with on tax treaties: the limitation of benefit clause and the principal purpose test. This is coming from the Action Plan 6 of the BAPS, where it provides for safeguard against treaty abuse and treaty shopping. And this Action Plan 6 has a three-pronged approach One is they say that look, all the treaties should have a statement of intent, and the statement of intent is that the tax treaty is to avoid creation of opportunities of non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements. So this is what the web section plan recommended, that a clear statement should be there in the treaty, which you now find in the multilateral treaty that as we'll see a little later, that the title of the treaties have changed and the preamble of the treaty has changed to bring in this aspect of tax evasion and tax avoidance as one of the features of the tax treaties that we don't want. We want to provide for double taxation without giving any creating any opportunities for tax evasion. So this is one aspect. Second aspect is provide for what is called as limitation of benefit clause in the treaty. And third is have in the treaty a sort of a GAAR, that what is the principal purpose of this particular transaction? Is the principal purpose getting the benefit of the treaty? If the answer is yes, then you don't get the treaty. Okay, so this is what has been recommended. So now let's see one after the other. What is the limitation of benefit? What is LOB? LOB is a clause in the tax treaties, which is a sort of a SAR, a specific anti-avoidance provision, a specific provision aimed at treaty shopping. And it essentially says that a person, if he wants to obtain treaty benefit, he should be a qualified person. Who would be a qualified person? A qualified person would be someone who is genuinely a resident of that country. So, how do you determine who is genuinely a resident of that country? So there may be some parameters. Web section plan has suggested some parameters. The multilateral agreements today the drafts that we have and what India has signed just on the 7th of June, there are certain parameters of LOB. So by and large it says that if there is a company which is a listed entity in that country, then it will be entitled to the treaty benefits, because what is presumed that the listed entity is a genuine entity in that company, is not just a nameplate company. Or if that company is owned predominantly by the people who are residents of that country, so on the ownership criteria. Okay. Or if there are certain charities or the collective investment schemes who would collect investments from various countries and who would invest in some countries. So treaty benefits will be limited to entities that will be regarded as qualifying persons only. So if you are not a qualifying person, so in other words, if you are a nameplate company, you don't have a particular ownership pattern, your owners are not the residents of this country somewhere else, or if you do not have a particular turnover in that country, that means you are only a nameplate company, you don't do any activity of substance, then in that case you will not be entitled to the treaty benefit. So this is a limitation of benefit clause with a specific anti-avoidance provision which has been suggested by BEPS and implemented under the web section plan 6. You have other examples of SAR in the treaty. Beneficial ownership concepts are there, arm's length concepts are there, force of attraction rules are there. Then you have the spatial relationships. If the royalty is on account of spatial relationships, then it will not be taxed at a concessional rate, but it will be taxed at a full rate, etc., etc. Then substance over form. If you are alienating shares of a company which is predominantly a property company, then the tax would be in a different manner. But if it's a company which is otherwise a regular operating company, then that tax would be in a different manner. So these are inbuilt SARs which are there in tax treaties. Now, having looked at this diagram in the treaties, what is the interplay between GAAR and the treaty? To start with, what does the Indian Constitution say? Indian Constitution says that the state shall endeavour to foster respect for international law and the treaty obligations in dealing of organized peoples with one another. So, India must comply with the treaty obligation. So, if under the treaty I have said that the resident of a particular country will get this benefit, it has to respect that treaty obligation. That's what the Constitution says. Vienna Convention, which is considered as treaty of all treaties. Okay, what does it say? Every treaty in force is binding upon the parties to it and must be performed by them in good faith. That's the principle of what is known as pacta sunt servanda, that is, every treaty has to be honored. Now, it is on this basis that what if there is a provision of granting a tax benefit under the treaty, then even if there is a conduit company coming through a tax haven, or if it's through a treaty shopping mechanism, then also a school of thought is that because of this particular provision in the Vienna Convention, the treaty has to be honored. Of course, there will be a lot of debate on good faith, etc. Is it good faith? Is it not good faith? Etc. Now, as against this, we have, after the introduction of GAAR, we have section 90, subsection 2A, which says, notwithstanding anything contained in 2, the provision of chapter 10 shall apply to the SSE even if the provisions are not beneficial. So, 90 subsection 2 says what? Treaty, to the extent it is beneficial than the Act, treaty will prevail over the Act. However, 2A is exception to 2, and it says that, look, provisions of GAAR in this Act, chapter 10 is GAAR, provisions of GAAR in this Act will apply even if they are less beneficial than the treaty. Okay. So therefore, GAAR in the Act overrides the treaties. That is what the purport of this section is. If you look at the DTC draft guidelines, it says where SAR is applicable, GAAR will not be invoked. It is an exceptional, in an exceptional case of abuse behavior, which might defeat SAR, GAAR would be invoked. If you look at Shom Committee's recommendation where anti-avoidance rules are provided in a tax treaty in the form of limitation of benefits, as in the case of India-Singapore Treaty, GAAR provisions shall not apply overriding the treaty. That was the recommendation of Shom Committee. As against this, now look at circular number 7, question number 2. Will GAAR be applied to deny treaty eligibility in a case where there is a compliance with LOB test in the treaty? So I comply with the LOB test in the treaty. If there is a subjective test which says that my owner should be resident of that country or I should be doing a certain amount of turnover, I comply with that test. Having complied with that test, should I be getting treaty benefits automatically, or having complied, the assessing officer will still say, oh no, I would also like to see whether you are complying with GAAR or not, and therefore get into the applicability of GAAR. So answer there is, adoption of any of these rules in tax treaties may not be sufficient to address all tax avoidance strategies, and the same are required to be tackled through domestic anti-avoidance rules. If a case of avoidance is sufficiently addressed by LOB in the treaty, there shall not be an occasion to invoke. Whether it is sufficient, whether it is not sufficient, who decides? So therefore, once again, the answer is not the complete answer to the question. It is left open, and when it is left open, it means that if LOB is not sufficient, then GAAR will be applied. Who decides whether it is sufficient or not? So therefore, once again, ask the question: is the main purpose for tax avoidance, etc., etc. So 92A contains overriding provisions. There is an interesting provision, section 100 of the Act. It states that GAAR would apply in addition to or in lieu of any other basis of taxation. And single sentence, one small section in the Act, making a huge difference to what we have learned so far. It says GAAR would apply in addition to or in lieu of any other basis of taxation. So one of the bases of taxation could be a treaty or LOB, but GAAR would apply in addition to or in lieu of. So it seeks to override everything. However, at the same time, mere tax benefit under a tax treaty would not automatically lead to application of GAAR unless other conditions prescribed in 96(1) are fulfilled, which of course you will see in the session to come. GAAR provisions are in addition to LOB or other anti-abuse provisions of the Act. This is the analysis which one understands from the reading of these provisions and commentaries and circulars. The next one in line is this principal purpose test, which is again an offshoot of the Action Plan 6. And what does it say? It essentially has two parts. I just read that relevant article and take it. Notwithstanding the other provisions of this convention. Now this is a draft article in a model treaty. Okay. Notwithstanding other provisions of this treaty, a benefit under this treaty shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all the relevant facts and circumstances, that obtaining that benefit was one of the principal purposes of an arrangement or transaction that resulted directly, indirectly to that benefit. So, I will not grant you the treaty benefit if the obtaining of the benefit was one of the principal purposes. Might well the Indian law says the main purpose was tax benefit. The main purpose, tax benefit. Treaty, one of the principal purposes was that of getting treaty benefit. One of the principal purposes. Difference between the two. But then it carves out an exception and says, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provision of the convention. So the tax department will allege that one of the principal purposes is that of tax treaty benefit. It's very easy for the tax department to say that. You may have 10 commercial reasons, but one of the principal purpose is tax treaty benefit. So the task of the department is over. Look, this is one of the principal purposes. Now you tell me why it should not apply to you. So the SSC will have to say that, look, whatever I have done is in accordance with the object and purpose of the treaty. Now, object and purpose of the treaty may be to avoid tax evasion is one of the objectives. But the objective could also be to enhance the economic relationship of the two countries, to enhance the investment opportunities to the investors in other countries. So therefore, is my action of coming to this particular country in line with the object and purpose of the treaty? If I am able to say that, then the PPT test does not apply to me. This is what the PPT test is all about. Now, obtaining tax benefit is one of the principal purposes. Onus is on the department. So department will have to say, okay, you have this 10 purpose, one of the purposes is this. Arrangement is in accordance with the object and purpose is what the defense of the taxpayer is. Now, if you look at in PPT also, it talks about arrangement and transaction. If you look at Action Plan 7, it talks of an arrangement or transaction, and the commentaries attached to this particular clause, PPT clause. Arrangement or transaction will include agreement, understanding, scheme, transaction, series of transactions, whether or not they are legally enforceable. There is a language over there. India has adopted more or less the same thing and probably more stricter than that. India's definition of arrangement is any step in or part of or whole of transaction, operation, scheme, agreement, understanding, whether enforceable or not. More or less the same language. Then, Action Plan 6 gives a very extreme example of an arrangement. Say, where steps are taken to ensure that meetings of the board of directors of a company are held in a different country in order to claim that the company has changed its residence. That also could be regarded as an arrangement. So merely because you are conducting your board meetings in a particular country, that's an arrangement. And therefore, if that is an arrangement which is sort of a make-believe arrangement, we'll get into it, we'll see that whether this is done only for the purpose of getting a treaty benefit or not. The question is, how to determine these two aspects? One aspect, the main purpose is, one of the principal purposes is to get tax benefit or treaty benefit. And the second is whether and to what, whether whatever I have done because it is in accordance with the object of the treaty. How do I determine these two things? Extremely subjective, extremely difficult. So therefore, some of the tests that we find, or some of the aspects that we find, we must look at in determining. The first aspect, the principal purpose is to obtain treaty benefits. Undertake an objective analysis of aims and objects of all the persons involved in the arrangement. So you have this arrangement of different players in this whole game of treaty shopping, etc. See whether, what are the aims and objects to each of them, whether each of them are companies of substance or not. party to it. A conclusive proof of tax avoidance is not required. But it should only be reasonable to conclude after an objective analysis that the principal purpose was tax evasion. Again, looking at merely the effect is not sufficient. What is the reasonable explanation of, as I said earlier, why you have done what you have done? Earlier, the tax department was not entitled to ask you this, why you have done what you have done. So long as what I have done is within the four corners of the law, fine. You don't have to ask me questions, you don't have to sit on the armchair of the assessing officer. But now, that's not possible. We are undergoing a changing times. You will have to have a reasonable answer as to why you have come through this particular country. Why you have done what you have done. What's the reasonable answer? Mere denial is not sufficient. Merely because I say, no, this is not treaty shopping, that's not sufficient. Okay? How to determine the object and purpose of the relevant provisions of the treaty? The object and provision of the treaty can be from the title of the treaty, from the preamble of the treaty, reading the treaty as a whole, reading the commentaries and model commentary to the model convention. If there are no reservations by India, then that would be also an aid to interpretation as to what is the object and what is the reason. Now, if you see the title and the preamble, which has been amended by these multilateral agreements today after the Taxation Plan 6, Convention between state and state for elimination of double taxation with respect to taxes on income and on capital and the prevention of tax evasion and tax avoidance. So that becomes the title of the treaty. Prevention of tax evasion and tax avoidance. Now you have evasion and avoidance in the same breath. We are saying these two terms in the same breath. This was not there earlier. Okay, so to prevent tax evasion and tax avoidance, this treaty is entered into. One of the preamble, intending to eliminate double taxation with respect to the taxes covered by this agreement without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements aimed at obtaining relief provided in the agreement or indirect benefits. So therefore, how does the taxpayer say that this is within the objects or not? These are the things. The title and the preamble will always come in your way. But reading an article of the treaty we'll see by way of one or two examples. Interplay between LOP and PPT, we find that there may be an LOP, there will be a PPT, there can be both in the treaty. And we find from the commentaries there that the LOP, even if you are passing a LOP test, PPT can still apply. This is very clearly stated in the commentary to Article 10(7), paragraph 4, which says that even if the limitation of benefit is satisfied by you, still principal purpose test will have to be satisfied. It's not enough that LOB is satisfied. And they have given an example that you may be a public listed company and therefore LOB is there. But whether a public listed company is there for the purpose of treaty shopping or not is something to be seen. Therefore, we are entitled to ask you questions what is the principal purpose. So therefore, it is not as if that I have satisfied LOB, PPT will not apply. No, even if I have satisfied the LOB, principal purpose test will still have satisfied. Let's take some illustrations to understand. India and Ireland have a treaty. It includes royalty. In the definition of royalty, normally we find use of equipments is royalty. Now, India-Ireland Treaty has this definition that use of equipment is royalty. However, it specifically excludes use of aircrafts. Now, this is there with Ireland with several countries in the world. So, therefore, we find what today Ireland, aircraft leasing is a huge. Ireland is a huge hub for aircraft leasing. It is through Ireland that the aircrafts are leased all over the world. That being the position, now the question will arise, oh, is this treaty shopping? You are sitting in the US, you are sitting in France, you are leasing this aircraft through Ireland. Is it treaty shopping? And therefore, principal purpose test fails. Ignore Ireland-India treaty, I tax you based on your precedents. Can you do that? Now, if you look at this, as I said, yes, principal purpose is probably to avoid tax. But whatever I am doing in order to subserve the objects and purpose of the treaty. Can I say that or can I not say that? What is the purpose of the treaty? When in the treaty you have said that royalty includes equipment leasing other than aircraft. India has signed it. Everyone has signed it. So therefore what? The intention is that you want to give a fillip to that aircraft leasing industry in Ireland. And if that is the intention, that is the economic reality, economic reason why you have signed this treaty, you have to read the treaty as a whole. The intention and the objects come out very clearly. Why does other treaties not say that? Why do other treaties not say so? It is this treaty which is carving out an exception, and therefore it is a conscious effort. It's not something which I am surreptitiously taking advantage of. It is something which you have very clearly given to me. Having given to me clearly, now you cannot say that I am not satisfying the principal purpose test. Because principal purpose test has two elements. One is purpose of mitigating the tax, and second, I have a defense, the SSC has a defense to say that so long as it is within the objects and aims of the treaty, it's not impermissible. So this is one example, and this is something which is hot and can create a lot of litigation in the European world. Second is Philippines. India, Philippines, and Philippines otherwise with various countries, whatever treaties they have, they don't have FTS clause. So you find the engineering companies and the repairs and maintenance hubs over there in the Philippines. Why? Because those that activity which is carried out over there, there is no FTS clause, and in absence of FTS clause, if there is no permanent establishment in India, a person making payment to him will not be withholding tax in India or any other country for which it does. So therefore, there's another aspect where can PPT be applicable? I would feel no, PPT cannot apply over there. Yes, I have gone to Philippines because it has a good treaty network, and there is no FTS clause. I have gone there because of that. But at the same time, it is within the purpose of the treaty. You don't have that clause in the treaty. So therefore, the aim, right, whereas the treaty of the entire world has this particular clause of FTS. You have consciously signed a treaty which does not have an FTS clause, and therefore, if it does not have a clause, you have to honor that treaty. And therefore, you can't apply a PPT test, or you can't apply a GAAR to me and say that you will not be able to get that treaty. Then take for example, make available clauses. In UK, USA, Canada, Singapore, you have make available clauses in the treaty. It restricts the scope of the taxation of fees for technical services. So would you say that no, I want to Singapore only for the purpose of getting that benefit of that clause? No, you can't say that. You can't apply PPT or GAAR for that purpose. Then there are certain illustrations which are given in web section plan itself, where RCO, a resident of say R, a state R, for expanding its business globally has identified three different countries with similar economic and political environments. It selects state S for setting up its business on account of favorable treaty with R. Okay, so my purpose is to expand. I have three different options. All are equal options in terms of economic and political environment. But then, out of these three, only one provides a good treaty with me. So therefore, I go to that country because it gives me a good treaty. Will you apply a PPT? Answer is no. Because what is the prime motive of getting into that? Prime motive is not doing a treaty shopping. I am opening a genuine shop over there, and therefore, the expansion of the business is the principal purpose, and you can't say that getting treaty benefit was the principal purpose. That's an example which has been given in the web section plan itself. RCO is a collective investment vehicle managing diversified portfolios of investment globally. It has significant investment in state S on account of favorable treaty on dividend taxation. Whether PPT applies, answer is no, because the intent of the treaty is to provide or encourage the cross-border investments. And therefore, it taxes lower tax on dividend in the source state. And that is the intent and purpose of the treaty. I am meeting the intent and purpose of the treaty, and therefore there is no question of applying PPT. Would GAAR apply if PPT is clear? There is another aspect. PPT is something which is there in the treaty. You pass the test of LOD. You pass the test of PPT under the treaty. Now the question will be, okay, fine, you pass those tests. But India says GAAR overrides treaty. So still can GAAR. Is there a difference between PPT and GAAR to that extent? Because as I said, PPT talks of one of the principal tests, one of the principal purposes, and GAAR says the main purpose, the main object. So to that extent, applicability of GAAR is narrower than as compared to the applicability of principal purpose test in the treaty, because there the scope is wider, here the scope is narrow. So if it is not one of the main purpose, then it cannot be the main purpose. If it is not one of the principal purposes under the treaty, it cannot be the main purpose for the purpose of the act. So in such circumstances, answer is no. But when you come to the second level, that okay, that was one of the principal purpose, but I am doing something which is within the object of the treaty, and therefore PPT does not apply to me. Fine, PPT will not apply to you because of that. Can you come back to that and ask me a question that why you have gone there? Can you ask me that question? Difficult to answer, to my mind, no. That question cannot be asked. When the treaty itself provides for the anti-avoidance rules, PPT is a general anti-avoidance rules. I don't think that you can go into a general anti-avoidance rules under the Act. But then this is something which can be left open. There are a couple of case studies which can take up the next 1 or 2 minutes. A wants to convert itself into an LLP. It has more than 60 lakhs turnover, and therefore it cannot convert into LLP without adverse tax implications. So it enters into a convoluted scheme. It finds B Limited, which is a company which has less than 60 lakhs turnover, first merges with that B, and after merger converts that B into LLP, because you have to see the 3-year track record of B, which is clear. The question is whether GAAR can be invoked in such cases, and leave it open for the people to answer that. ABC, it is proposed to sell the shares of C to another company D. In case the shares of C Limited are directly sold to D, D Limited will be liable to tax in the country of incorporation. Then you work out an option. D is liquidated, and having liquidated, 46(2) tax will come up. But then A is in a treaty heaven company, treaty advantages company. So therefore, no tax on that. So therefore, thereafter A sells the shares of C, again gets a treaty benefit, and therefore no tax in either case. Now, will GAAR apply to such situations? To my mind, answer is no. But then these are the borderline issues which can come up. And finally, a word on burden of proof. Shown committee clearly said that the burden of proof will be on the revenue. If you look at the finance minister's speech, it clearly says that the amendment has happened to the GAAR to remove the onus of proof entirely from the taxpayer to the revenue department before any action is initiated under the GAAR. So really, it is for the revenue to say that that for these reasons there is the avoidance of tax benefit is the main purpose, and these are the reasons why I want to invoke GAAR, and then issue me a show cause, which is also coming out very clearly from section 10. There's an interesting decision under section 10A of the Excess Profit Tax Act, where we had a provision which said that when the main purpose was the avoidance of reduction of liability to excess profit tax, then the assessing officer had the leeway to make certain adjustments. Now, under this act, we have a decision of the Madras High Court, which was ultimately upheld by the Supreme Court in 44 ITR. Then, if you see the second bullet point, says the burden is on the department to prove that this was the main purpose with which the transaction was effected. So here also the main purpose, the language here and language there is more or less the same. Main purpose is the language, and therefore. Then thirdly, you have section 96(2), which creates a little bit of difficulty, where it says that an arrangement shall be presumed unless it is proved to be contrary by the assessee to have been entered into or carried out for the main purpose of obtaining tax benefit, if the main purpose of a step in or a part of arrangement is to obtain tax benefit. So therefore, the whole transaction, there is a part of a transaction.
If the part of the transaction's main purpose is tax avoidance, then it will be presumed that the whole of the transaction is for tax avoidance. But then, whether that part is for the purpose of tax avoidance or not, that is for the department to first prove to me and issue me a show cause based on certain specific information in his possession. Section 144BA also throws light on this, that if the assessing officer at any stage of assessment or reassessment before him, having regard to the material and evidence available with him, considers that it is necessary to declare an arrangement as impermissible and to determine the consequence within the chapter 10A, he may make a reference to the principal committee. So therefore, it is for the department to initiate it. That initiation can be only on the basis of material and evidence available with him, not otherwise. Rule 10B also says that when he issues me a notice, he has to issue me a notice together with all these things, details of the arrangement, the tax benefit that I am gaining, the basis and the reasons for considering that the main purpose is tax benefit, and the basis and the reasons why the arrangement is considered as impermissible under 96(1), and the list of documents and evidence relied upon by him. So all these things he will have to give you along with the show cause. So therefore, the initial burden is on the department and not on the assessee. I order to prove myself to be innocent. He has to say, based on material, that you are guilty, and then the onus shifts on me to prove that I am not. Thank you very much for being here.